Let us now look at some less obvious asset, the unexpired portion of prepaid expenses. Case Study 7. Prepaid expenses. On December 2, when Karthik contacts an insurance agent regarding insurance coverage for the truck just purchased, the agent informs him that $1,200 will provide insurance protection for the next 1 year. Karthik immediately writes a check for $1,200. How do we account this on the balance sheet? Let us first look at the balance sheet implication. On the asset side, cash reduces further by $1,200 and prepaid insurance account increases to $1,200. On the liability side, no change in stockholders' position. What is impact on the income statement for the month of December? Fastrack pays $1,200 on December 1 for a 1-year insurance premium on its delivery truck. That divides out to be $100 per month. That is $1,200 divided by 12 months. Between December 1 and December 31, $100 worth of insurance premium is used up or expires. The expired amount will be reported as insurance expense on December's income statement. The remaining $1,100 of unexpired insurance premium would be reported on the December 31 balance sheet. Please note, the portion that expires in the current accounting period is listed as an expense on the income statement. The part that has not yet expired is listed as an asset on the balance sheet. Coming to debit and credit for Case Study 7. On the asset side, prepaid insurance increases by $1,200 and hence debit. Cash decreases by $1,200 and hence credit. It is time for us to now revisit raising debt. Case Study 4. Revisited. Raising debt. Fastrack Movers and Packers borrowed $20,000 from a bank to start his business on 1st December, and the company agrees to pay 5% in interest, or $1,000. The interest is to be paid in a lump sum on December 1st of each year. How will this transaction get accounted for on the balance sheet? As Karthik raises further money through debt, cash increases by $20,000. However, Karthik is liable to return the amount after the term and hence debt termed as liability. On this debt, Karthik will have to pay interest expense as discussed earlier. Coming to debit and credit for Case Study 4. On the asset side, cash increases by $20,000 and hence debit. Long-term debit increases by $20,000 and hence credit. Case Study 8. Inventory. Karthik keeps an inventory of packing boxes not only to use it for his business but also earn additional revenues by carrying an inventory of packing boxes to sell. Let's say that Fastrack Movers and Packers purchased 1,000 boxes wholesale for $1,000 each. How do we record this on the balance sheet? We have now done this transaction recording a couple of times, so it should be fairly simple. Cash decreases by $1,000 and inventory increases by $1,000. On the liability side, there is no change. Scenario 1. On 10th December, wholesale price of boxes has been risen by 20%, and at today's price, Karthik could purchase them for $1.20 each. What is the value of inventory shown on balance sheet? We should remember two important principles pertaining to inventory. Cost principle. Each of the company's assets is recorded at its original cost, and even if the fair market value of an item increases, we will not increase the recorded amount of that asset on the balance sheet. Only lower of the original cost or fair market value is taken. Law of conservatism states that if the value of an asset decreases, then we take the record that decreased value in our accounts. For scenario 1, if we apply the above principles, the replacement cost of his inventory is 1.2 multiplied by 1000 is equal to $1,200 is higher than the original recorded cost, $1,000. The principle of cost directs the accountant to report the lower amount at cost at $1,000 as the asset's value on the balance sheet. Scenario 2. Let's say that since the time Karthik bought inventory, the wholesale price of boxes has been cut by 40%, and at today's price he could purchase them for $0.60 each. What is the value of inventory shown in the balance sheet in this case? Because the replacement cost of his inventory, that is $600, is less than the original recorded cost, that is $1,000, the principle of conservatism directs the accountant to report the lower amount, that is $600, as the asset's value on the balance sheet. Debit and credit done on case study. Inventory asset increases by $1,000 and hence debit. Cash decreases by $1,000 and hence credit. Unearned revenues feature primarily in current liability. This is the money received in advance of actually earning the money. Let us look at case study 9 to understanding this in detail. Unearned revenues. In addition to 200 parcels received by Fast Track Movers and Packers in December, they enters into an agreement with one of its customers stipulating that the customer prepays $600 in return for the delivery of 30 parcels every month for 6 months. Assume Fast Track Movers and Packers receives $600 payment on December 1, 2007 for deliveries to be made between December 1, 2007 and May 31, 2007. What is the effect on the balance sheet? Karthik's Fast Track has a cash receipt of $600 on December 1, but it does not have revenues of $600 at this point. It will have revenues only when it earns them by delivering the parcels. On December 1, Fast Track will show that its asset cash increased by $600, but it will also have to show that it has a liability of $600. What is the effect on the income statement? The liability account involved in the $600 received on December 1 is unearned revenue. Each month as the 30 parcels are delivered, Fast Track will be earning $100, and as a result, each month $100 moves from the account unearned revenue to service revenues. Each month, Fast Track's liability decreases by $100 as it fulfills the agreement by delivering parcels, and each month its revenues on the income statement increases by $100. Debit and credit for case study 9. Asset side. Cash increases by $600 and hence debit. Liability side. Unearned revenues increases by $600 and hence credit.